Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is March 12th, 2025, and we're diving into Ferguson's second quarter earnings report. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Ferguson has released their Q2 2025 results, and there's a lot to unpack, from sales growth to strategic acquisitions.
Revenue and profitability overview. Let's start with the top line. Ferguson reported net sales of $6.9 billion, a 3% increase from last year. John, what are the key drivers behind this growth?
Ferguson's revenue growth was primarily driven by a 5% increase in sales volume, despite a 2% deflationary impact. The company outperformed the market, which is impressive given the challenging conditions.
And how about profitability?
While the gross margin decreased by 70 basis points to 29.7%, the adjusted operating margin stood at 6.5%. The adjusted EPS came in at $1.52, slightly below the forecasted 1.58 cents, but still a solid performance considering the market conditions.
Strategic initiatives and acquisitions. Ferguson has been active on the strategic front. Can you tell us more about their recent acquisitions and share repurchase activities?
Absolutely. Ferguson completed the acquisition of Templeton and Temsco, which strengthens their position in the water and wastewater industries. They also signed an agreement to acquire Independent Pipe and Supply, a leading distributor in the Northeast. Additionally, they repurchased $252 million worth of shares and increased their share repurchase program by $1 billion.
And what about dividends?
They declared a quarterly dividend of 83 cents, marking a 5% increase over the previous year, which is a positive signal to investors about their confidence in future cash flows.
Market challenges and future outlook. Ferguson is navigating some tough market conditions. How are they addressing these challenges, and what does their future outlook look like?
Ferguson is facing subdued market conditions and persistent commodity price deflation. Despite this, they reaffirmed their full-year revenue guidance of low single-digit growth. However, they adjusted their operating margin guidance to 8.3% to 8.8% due to these challenges. They're also taking steps to streamline operations to enhance efficiency and better serve their customers.
It sounds like they're positioning themselves for future growth despite the current headwinds.
Exactly. They're balancing cost management with strategic investments in key opportunities, particularly in the residential and non-residential markets, which should support their long-term growth.
Key takeaways. To wrap up, Ferguson has shown resilience in a challenging market with strategic acquisitions and a focus on operational efficiency. John, any final thoughts on their investment prospects?
Ferguson is well-positioned for future growth, thanks to their strategic initiatives and strong financial management. While there are challenges, their proactive approach to cost management and market expansion bodes well for long-term investors.
Thank you, John, for your insights, and thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Ferguson's performance in the comments below.